Dude, so what a day it's been. I mean, this whole week has just kind of been shit for equities, which, I mean, we're doing pretty good. We pivoted to bonds a couple of weeks ago, so we were able to sidestep this. It's pretty good.
Yeah, I mean, look, honestly, um, a lot of things have been going on, right? Like number one, we have had this huge I'm sure you saw, right, this huge rally in small caps, monster run, right? IWM just ripping higher. Which we did actually speak about a few weeks ago, right? In our
Yeah.
podcast. Yeah, small cap summer, we were talking about the reasoning for this, and really what this comes down to is just interest rates, right? So the expectation of lower rates, call it like a lower barrier of entry, a lower barrier of funding in the market, and therefore, um, companies that are more cash strapped or are margin compressed, they can expand, right? And like there's a lot of them that are shorted heavily, and I think that
Yeah,
because of the
I think
dynamic,
the move
right?
that we saw was a lot largely due to the short squeeze aspect of it and not so much the lower rate expectations, because I think if the market really did have that kind of lower rate expectations, we would have seen a larger move in bonds. So I think this was just a massive short squeeze, but for continuation of this move, I think we're going to need to actually see rates come down and actual good earnings performance coming out of these companies.
Yes, for sure. Obviously, I agree um, in that case with earnings and whatnot. But I do think there's just a general there's been a general boost in the market. Obviously, for those that don't know, or I guess most people know this by now, that over the last weekend they tried to assassinate the former President Trump, and they failed. And I think that there's some euphorism that comes off of that, right? Like obviously, we're not trying to get political here, but in terms of the stock market, let's just isolate this to the stock market for the conversation. Trump was really good for the stock market. And I'm not saying Biden's bad for the stock market, but Trump was good for the stock market, right? And Trump is a an American-based industrialist guy, energy guy, right? We saw things like XLE just skyrocket, right, this whole week, like energy names themselves are up, and
That was
it's
because
on
like his presidency was pretty much like solidified after that assassination attempt. So this
right,
is like
yeah,
the
and
market pricing in, like, okay, we're gonna have a Trump presidency. We may as well start pricing it in now.
right, and there's stuff like names like Caterpillar, for example, right? Like you can just see what I mean, right? This is I'm not making this up. Like for example, we go into Friday here at 3:35 on Caterpillar, and Caterpillar gets a two monsters run this week, right? And there's many names like this that just get this huge squeeze. And these are like the American-based names that people love. You know, they're American companies, and ultimately, like you have this like you just said, a pricing in aspect of the market where people are betting that Trump's going to be the president. Now, there's some consequences that come with this too, though, right? Obviously, you have the emergence of trade war issues, right? And we saw that today with TSM, right? I mean, TSM just down 8%, right? And these are
Well,
like
is
these.
is that why? Because it didn't initially move after the assassination attempt.
No, 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 no. I should have clarified. It's Trump, right? TSM is down because of Trump's stance on Taiwan.
Oh, right, right, right.
So I think that there's like some the market's obviously paying attention, right? The market's not going to write down its semis, specifically TSM, on Trump ideas if the market wasn't expecting those ideas to become reality, right? So I guess, long story short, it's obvious the market is playing the Trump hand at the moment, right? And that aspect of it is it's also clear in like the dollar. The dollar is like down this week and down today. Um, it's not bearish trend yet, but it's holding on. It's still there, and I think that ultimately, right, like everyone has this expectation of Donald Trump being this huge spender, and I always come back to the concept of, if you look at the same people that claim Trump's a huge spender would be the type of people that would also claim that Joe Biden added more jobs to the economy than Donald Trump, right? Because they're going to look at those. those COVID adjustments and not discount them, right? If you say Joe Biden was better for jobs than Donald Trump, right? Well, okay. In the sense of absorbing the COVID losses and the COVID rebounds, right? Yes, those stats are there. But the stats look completely different when you adjust for that. So, and I'm not saying Joe Biden has added no jobs. I want to make this very clear. This is not to be political. It's this, we're talking about what's going to happen next. So we have to kind of recognize what's happened in the past, right? Give some credit to where credit's due, and more importantly, analyze how things have progressed. And ultimately, Trump is seen as a weak dollar guy, big spender, right? That's what people want to have been portraying, have been saying. It's been the macro talk. Number one, I don't think Trump is as big of a spender as everyone's making him out to be, because you're giving the guy credit for COVID deficits, which in reality, those aren't normal, right?
But is
I,
the
I,
market pricing that in?
I
Or is
think
that
that
just
there's
what you're
some.
seeing like throughout Twitter?
I'm seeing that throughout Twitter, but I do think there's some discounting to be taken there, right? Because the consensus is that Trump is going to pretty much bring the dollar down, right? And you're seeing the dollar go down with that, which is giving me somewhat of like it's a confluence there, and giving me confidence in the idea that the market is expecting a lower dollar with Trump in office, right? So, okay, if that's the case, well, number one, first, dollar's got to go bearish trend. It's bullish right now. But if it goes bearish trend, then the odds of lower prices obviously increase significantly. And then from there, we'll just follow the trend lower. Now, do I think that the dollar is going to get ridiculously devalued? I don't know. I don't like to make obscene projections like that. Like, for example, like someone could sit here and say Trump's going to bring the dollar down to like 90, right? It's at 103. I don't think that's going to, I don't know. Obviously, we're going to ride the trends and ride the data as it comes in. That's a little absurd to say. So I think ultimately we have to look at it like this. Trump is seen as a weak dollar guy. Deficits are obviously going to continue. I don't think we're going to be running surpluses, right, anytime soon. And I think the question there is just the degree of the deficits, right? Are we going to be running 8-9% or 4 to 6%, right? That's the question that we need to kind of understand. And historically, based on what we saw Trump do in his throughout his first term, the entire term, it was around 4%. So to say he's going to run a 9-10% deficit, I don't know. Unless there's like a severe recession that happens, right? It doesn't make sense. But we'll see. We'll see what time has in store for us on that front. Ultimately, though, that's not really where the alpha's made, right? Like us discussing what politics and what Trump, what is going to be implied here by the market is important, but like that's not really where the returns are going to be made. So, as you said earlier, we did pivot long bonds. We are now long the bonds. Okay. If you guys are following us on X, I'm sure it's pretty clear we're long bonds. Without being straight up to the point, obviously, those that listen to this will get some insight. We won't explicitly say we're long bonds on Twitter. Ultimately, though, obviously, we're long bonds. So now, what does this mean? Well, a lot of people, and I want to bring this discussion into yields and dollar, and that's why we preface this with Trump and the idea of weaker dollar. But I want to bring this into yield, dollar, and bonds, because I think that's where we need to focus on right now. And I'll explain our viewpoints on why we want to do bonds. But I think I want to ask, you know what? Actually, do you want to explain why we think bonds are better than stocks right now?
Well, it's just the odds are a lot more in the favor of higher bonds versus higher stocks at the moment. Like right now, we are in a position where any little bit of bad data that comes out, we're going to start getting Fed funds futures pricing in more cuts. Like, in my opinion, there's definitely not nearly enough cuts priced in. We've got how many cuts priced in until 2026? Just like
I think
we're
we're at
still going to be at
3.5.
like, yeah.
Well,
So
3.5 rate, excuse me, not cuts. 3.5 terminal, right?
yeah.
So, but
So
continue.
like that's
Yeah.
like barely down. So the market's pricing in a full blown soft landing at this point. And as soon as data starts coming out, which we've already started to see weak data, but as soon as more weak data comes out, bonds are just going to be skyrocketing. And that doesn't necessarily mean that stocks are going to be going down, but they're not going to be going up at the same rate as when the market was pricing in high growth and this soft landing scenario. But as soon as like we start getting more of a hard landing scenario getting priced in, bonds are just going to be ripping. And I think the odds are well in that favor versus long equities. And like, I mean, we're seeing it now with this sell off in equities. Like it's just kind of teetering. Whereas bonds, they've been basing, they're at their lows, and we've got rate cuts on the horizon. We've got rate cuts being underpriced. So any more rate cuts that come in are just going to continue to push TLT higher. So that's basically our thesis. Obviously, we have the system backing that up. This is the narrative that we build around the system. But the system flipped on that dip that we had 2 weeks ago, and that's when we entered long. So it's a good trade so far. It's working out. Crossing our fingers
Yeah,
that it continues to
yeah,
work
yeah.
out.
But I want to kind of elaborate on what you said there, right? So about the system. This trade, so for those that don't understand, we are in a risk-off regime right now, but it's a unique risk-off regime. We're in a risk-off regime that is basically encompassing an economic slowdown slash softness, right? Doesn't mean we're in a recession. Just risk off in terms of there might be a dynamic shift in appetite for assets between this mega bid that we've been seeing in tech to more dispersion, right? And uniquely, because of the interest rate conditions that we've seen with the Fed doing the fastest hiking cycle in terms of rate of change ever, right? Um, that type of policy action kind of reversed a lot of people's expectations of what's going to happen, right? So, for example, small caps, they have this short squeeze driver behind them at the moment, but they also have this situation where if the Fed cuts interest rates and there's no recession, well, what happens now is you lower the cost to borrow capital for companies that are already under pressure. And we have a couple of thread posts about this on X, but ultimately you decrease the barrier to entry or the barrier to play for small caps without actually having a recession. So all this capital that got stuck into the Mag 7s, the QQQ, the reason why it was bid the way it was bid is if you don't expect duration the long end of the yield curve to fall, right? Where are you going to put your money? And if 4% coupons are not, sufficient, if you have a risk appetite that is beyond the risk curve of 4%, meaning you're not. So ultimately, people play bonds, right, for two reasons. The further you got in duration, the more chances are you're trying to lock in a coupon, but you're looking for appreciation as well. So if you don't see that appreciation factor on the table on long bonds, then what happens is you're forced into equities, right? And now there's obviously some demand at 4.5 or 4.25, right? So obviously we've been seeing a rotation here, right? In terms of capital going from large cap mega caps into small caps, and some may be driven by the small cap short squeeze, which is a driver at the moment. But ultimately what happens is, and we explain this, we have a couple of threads on X about this, and we've been adamant about this in the podcast, is when you lower interest rates without a recession, you decrease the bar to play, basically the barrier to entry, for all of these small cap companies, right? The ones that maybe had distressed margins or barely profitable, borrowing a lot of money. They can tap into some credit facilities at cheaper rates, right? Especially because forward guidance is so powerful, right? They have the ability, the front end, the longer end of the market's going to move before the Fed even cuts rates, right? Because as you price in rate cuts, 5-year, 10-year, it's all going to get cheaper, even though the Fed hasn't cut yet rate, right? Like that's how this works, right? So ultimately, like the idea of cutting into a non-recessionary environment allows easier access to capital for small cap companies and basically better margins. Therefore, there's an appetite that comes up for them or comes back. And what you've been seeing in this mega cap bid is not all it's not all nonsense. It makes sense, right? So when you have duration, if you look at long bonds, like paying 4.25, right? The one thing, so you get paid 4.25 for buying them. Now, bonds have two things. They have coupons and they have principal appreciation, right? Meaning you're placing two bets. The bet that you're going to get your interest payment, right? So you have that credit worthiness of the underlier of the country in terms of treasury. You're betting on the United States paying back. And you have the bet that the Fed's going to cut rates, so your principal value of bond goes up, right? So I think that there is that dynamic, or I think that dynamic between bonds has been broken for some time because of no rate cuts, right? At every attempt, the market was pushed back on rate cuts. So you didn't really have that principal driver on bonds. You're stuck with coupons. So coupons are good, but there's no growth there. And if your principal is not going to appreciate, you're going to just say, okay, people that might speculate in bonds are not going to speculate. They're going to stay in large caps. And I think that's what's happened because you created this barrier, right, where small cap access is constrained. I mean, small cap access is, I shouldn't say constrained, but the bar's high, right? And then you're left with like betting on the MVPs, the most valuable companies, right? You don't want to put your money behind something that's not going to be able to make money, right? Especially in an environment where there's a high cost of credit, and MVPs do well in this environment. That's what we've been seeing. And I think as that bar comes down, there's the door opens for dispersion. And ultimately, right, I think that
what do
Go
you
ahead.
think? What do you think people should be looking at to see when we start moving from a slowdown to an actual recession? Are small caps something that we can look at where even the idea of rate cuts are not bullish for small caps? Like they start acting bearishly and selling off.
100%.
Is that something we
100%.
can look for?
100%. So what I would say is this. The soft landing will obviously show up in our system likely before it does anywhere in terms of like, if let me put it to you this way. If the GDP now model is signaling it, it's already been baked into the market. It's just confirmation that like everyone understands what's going on. That's what happens, right? I don't think you can look at the GDP now and say, oh, well, we're falling, we're negative now. GDP now is negative. Now it's time to start thinking about a hard landing. That's nonsense. If the GDP now is negative, the market's already been pricing that in, right? So I think like if you're going to take a high level view and you want to take such a low touch approach, take a look at small caps. Small caps, if we're going to go for a soft landing / light, I'm talking like a skim of a recession, right? Something that's like really, really slow, but not like actually receding. Like we're talking like, I don't know, maybe 1% real GDP growth, like something like it on that, in that barrier, in that belly. Then small caps probably don't do the best, but they're probably not going to get smoked, right? So like that's your barometer. But if you start seeing small caps getting smoked, I would start getting scared.
Yeah. So
Now,
like if they're not getting smoked, but they're also not really moving much, that's more of a slowdown scenario. If they're
and that's
getting
likely,
smoked, that's
yeah.
that's when we start moving into recession territory.
Right. And like realistically, I think this goes back to what we were saying earlier. We don't like look, it's very funny that you say this earlier about like the our views on the economy, like stocks not going down, right? Stocks don't have to go down for bonds to go up. And I find this very fascinating because most people on X, when they look at when you try to look and follow this long bond idea, right? A lot of people are bearish bonds for two reasons. Number one, term premium, and number two, duration, deficit spending. Right. Number one, people will look at like let's take a look here. So let's see, term premium on a 10-year. They'll look at term premium at negative territory and say, oh, no reason to buy bonds. There's no term premium, right? I'm not getting paid to hold duration. Well, you haven't been getting paid really anything to hold duration since Bernanke set the floor, or set the 2% inflation target in 2012. You barely ever got, maybe the most you got paid was 50 bips ever to get to hold duration since 2012. And why is that? Why do you think that is?
People don't buy bonds for the coupon. That's not the goal.
Right. Well, especially duration, right? Well, it's, to some degree, yeah, but like ultimately, the reason that the 2% inflation target is believed to be attainable over the long run in terms of the Fed's going to always work to get inflation back to target, right? So Why is there going to be a significant premium on duration on the premise that inflation is a serious risk? There won't be, right? I don't expect term premium to do anything drastic as long as that 2% inflation target remains intact. A good example, if you believe the inflation target's going to be lifted, term premium then would start shifting. But if the inflation target's going to stay at 2%, as it has been, then I expect term premium to like gyrate between these two, or gravitate, I should say, upper to lower bound. Like it's just going to like flop around here. It's not going to do much. And rightfully so, as it should. Like, why is there going to be a significant premium or a significant discount outside of when we're at ZERP, right, for duration? Like, it's just going to be range bound. Therefore, I find that term premium argument kind of nonsense, to be honest with you, right? Whatever. Throw term premium at the window. Now, deficits. And this goes back to the original point in the podcast. I don't think Trump's as big of a spender as everyone's making him out to be. Meaning, I think we might actually experience, if you remove the 21 period and 2020 period, the deficit to GDP might actually go down in a Trump presidency. Granted, there's no obscene recession. And that's if we get Trump as the president, right? I don't believe deficits are going to ramp out of control. We'll have to see that, though. Ultimately, though, I kind of get this idea that maybe the risk of a bear steep. So a lot of people look at the yield curve and say, well, the way this is going to revert this time is not through the front end rates coming down, but through the long end going up, because the Fed's going to have to issue a lot of duration. I mean, the Treasury's going to have to issue a lot of duration, and the Fed is not going to be able to really buy it because they're not doing QE. Therefore, it's going to hit the market and blow up long ends, right? The long end yields. Again, we have a couple of months left here before election. We'll have to see what happens. Likely, nothing's going to get done right away, anyways. If there's a regime shift, and it's going to take some time for the market to absorb it. But I don't, in terms of spending, I don't know if there's much that's going to happen between now and the election that's going to change the game here. Right? That's how I look at it. So in terms of like yield curve pressures, I don't like if the damage wasn't done already, I don't see what's going to cause it now, type of thing. Right? So ultimately, I think a lot of these fears in the bond market are quite overstated at the moment. I could be wrong, right? Things can happen in real time. Maybe so for example, this is a good way I like to always look at things. Like, let's just say that the narrative that I just explained about long end rates blowing out, right? Just blowing out because of issuances or whatnot. Well, what's going to have to happen for that to happen is bonds are going to have to go bearish trend well before long end rates blow out. Meaning, we're going to be stopped out, right? So if that thesis comes to fruition, we're not going to really get smoked in the process.
Yeah. And I mean, that's not going to happen until Trump's in office.
Right.
So we
to
still
that
have
degree, yeah.
plenty of time till that's even an issue. So much can change till then. We might be long equities at that point. Who knows?
Who knows, right? And God willingly, I hope nothing bad happens to the guy, and I hope nothing bad happens to any president, Biden, Trump. But obviously the assassination stuff is not. I think that's something that is kind of new for this generation, right? In terms of presidencies, it's not something that most people in North America or even Canada, right? Having a president or a prior president or a runner being, having their life attempted, right, is not something that's normal,
No,
right?
definitely
It's just
not.
abnormal.
I don't think
So
I haven't heard of that happening in Canada at all.
right. So you look at that and it's okay, it's just a new paradigm. Are we gonna have more and more issues like this going forward? Or is this a one-off event, right? That's how we have to start thinking about. But I think right now we have to be optimistic and just say, look, okay, whatever happened there, hopefully they better up security going forward. We won't run into this issue. Long story short, though, for the presidency, I think we just have to look at it like this. It looks like it's going to be a Trump versus Biden race at the moment. And the winner of that, if it is Trump, I think it's going to have a lower impact on issuances, or I should say on deficits, than what is at least being perceived. I don't think Trump's going to run 9%, 8% deficit to GDP ratio. I just don't.
Well, so
right?
what do you see as the bear case for this TLT trade? Like before the election, like right now, what even is the bear case? So I could think of two. So one is we get a slowdown, which is barely a slowdown, and that's just going to cause bonds to just chop, not really pick a direction. Or the other one is inflation comes back, which we've had so many podcasts talking about that. Inflation is not coming back. It's pretty evident at this point. What other bear case is there to this? I feel like it's a very well-rounded trade where with really good odds by going long here.
Yeah, well, I think the first thing we have to address before we go into like bear, I guess, wrong scenarios, right? Bear scenarios would make us wrong, is our trade location, right? On these bonds. We're in at 91, right? Roughly on TLT, roughly 91. So ultimately, like a lot of damage has to go on here rapidly for us to actually like get smoked on the trade. But I think like in terms of trade location, we're in such a good position. We have a lot of like time and space to let the market figure itself out. And I think one of the bear things that would destroy the bond trade would be the Fed. Like, so I tweeted this out earlier this week, and I want to reiterate this, that like the Fed pushing back interest rate cuts at this point is only going to put them in a position to have to cut more later. But them pushing back interest rate cuts ultimately will negatively affect bonds on the front,
Yeah.
like in the short term, right? It'll have a negative implication on bonds. Now, I also think we have the QRA at the end of this month, right? And I know a lot of people care a lot about the QRA. I personally do not care too much, but when I'm long bonds, I have to somewhat pay attention to it because the QRA is going to move the bonds. Now, people like to do like some weird like correlation analysis and look back and like, oh, look at the QRA. The QRA flipped the duration offerings here. Bonds got smoked. But you know, they like to play these games. Look, the QRA will affect bonds, but the QRA is less impactful. Like in terms of like duration issuances, you have to really be scared when they start piling onto duration, like when they start issuing a load of duration, when there's no buyers there. And there are buyers in the bond market, and the bond market's very liquid. There's no constraint there, and the auctions have been pretty good lately. So I think like if we're not drastically changing the QRA like significantly, right? I don't think the bonds are really going to get as shaken up as they maybe would in a situation where heavily based on duration, or I should say the change from the prior is, or the estimates are significantly more on duration than obviously would shock bonds up front. I don't think that should be our base case at the moment. I do think that we have to pay more attention to, at this point, actually, believe it or not, the dollar, as I said earlier. And this is what I want to say on the dollar. So we're in a situation where the dollar and interest rates have a positive correlation. Okay? Meaning, if we're long bonds right now, we want the dollar to actually fall. Right? Now, some of you guys listening to this might say, whoa, whoa, whoa. There's a natural understanding that the dollar and should rise with rates falling, right? Because in a negatively correlated environment, the dollar is going to go up because people have demand. There's demand out there for dollar denominated assets and specifically treasuries, right? So okay, dollar up, they use the dollars to buy bonds go down, right? And that is something that is not abnormal. That's what the base case for a lot of people are, but there's levels to this stuff. And a big defining factor is the position of the yield curve. So if the yield curve is negative historically, and real yields are up and rising, right? Real yields are positive. Dollar and interest rates are going to have a positive correlation. So meaning if the dollar continues to fall and the yield curve is inverted, what's going to happen is interest rates are going to go down with it. Ultimately, what should happen...
Wait. So why is it different when the yield curve is inverted?
So what happens is when the yield curve is inverted, the reason for people accumulating dollars in terms of in the bond or slash treasury market's a bit different, right? So when the yield curve's inverted, what happens is the front end of the curve is artificially high, right? Because the Fed's holding rates high. And therefore, there's a congregation of assets in the money market funds and et cetera, right? Because people want the highest available rate. And if the highest available rate is the one with the smallest duration, right? People are going to want that over. Why pick a 30-year at 4.25 if you can get a 1 month at 5, right? And it's liquid. So you have this flock of assets basically into money market funds and cash, right? And the reason is when you have this inverted yield curve, if you look at the scope of how treasuries or bond, the whole treasury market is treated, the shorter you go in duration, right? Bills, for example, are treated more like cash because they're extremely liquid and they're constantly rolling. They have this high velocity, right? So, for example, in 2022, when we saw this ramp up in the dollar, right? But it wasn't because people were buying dollars or needing dollars to buy treasury bonds. They were using this to buy bills. Essentially, what was going on here was they were putting this money into bills, and it created this positive demand, this positive correlation between bonds, bond yields, and dollars. Where historically, what people assimilate this bullish move in dollars is people are accumulating dollars to buy bonds. Therefore, rates should go down, right? This demand for dollars rises and people chase bonds, therefore pushing yields down. And ultimately what we saw was yields actually rising with the dollar. And this comes back to the fact that, look, when you have money market funds demanding dollars, it's different than duration because the money market funds, they have this high velocity, right? Things are maturing every month, right? So those dollars need to be repurposed every month so that those dollars are tied up a lot more, where they don't really bleed into long end rates because it's forced on the front end. So what happens now is as the yield curve steepens, right? And we go from an inverted yield curve to a normal yield curve. What's going to happen is we likely shift in real yields. So ultimately, what should happen here is the yield curve should revert, real yields should pop. Therefore, giving us a negative dollar rate correlation where the dollar actually gets a bid. And this is likely to happen again if we weaken, the economy weakens into a more prolonged slowdown / recession. This would be the ultimate bond trade, of course, where the dollar pops and rates drop on a negative correlation because real yields stay elevated. And then real yields fall and the dollar rate correlation goes back to being positive, and therefore the bond trade would likely be over. That's likely the outcome of that whole bond trade. But this is, again, thinking very far ahead. Right now, yield curve's inverted. The likely exit of this is going to be a bull steepener, meaning the Fed is going to have to cut interest rates. And right now, we're looking at the Fed cutting rates to about 3.5% in 2026. And ultimately, for our bond trade to make significant amount of returns, we need to see that rate price in lower, meaning we need to see more cuts come in than what is already priced in. And as Artie has been saying at the beginning of the podcast, it doesn't necessarily mean stocks need to go down. We just think that bonds look more advantageous here than equities do at the moment. But thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar or go to our website at market-radar.com.